Today we need to talk about oil and gold and a much bigger question. Who really knows what's happening in these markets and how far in advance do they know it? Because what we're seeing right now in energy and precious metals is unlike anything in decades. I'm Farouk. On April 7th, 2026, somebody placed a bet that oil prices were about to fall. And it wasn't a small bet, not $9 million, not even $90 million. It was a $950 million bet. Now here's the thing. This bet was placed in the oil futures market just 20 minutes before a major announcement that sent oil prices tumbling was made public. This wasn't just a good guess, this was a bet of truly impossible precision. So, to understand how a bet like this could even be possible, you have to understand the global chessboard it was placed on. And that story starts with one of the most critical bodies of water on the planet. This is the Strait of Hormuz. At its narrowest point, it's only 33 miles wide, and yet through this tiny choke point flows about 20% of the world's entire daily oil supply every single day. Think about it. The oil supplies of major producers like Saudi Arabia, Iraq, and Kuwait all depend on this one narrow passage. Well, in March of 2026, Iran closed it. The head of the International Energy Agency didn't mince words. He called it, and I'm quoting him directly here, the greatest global energy security challenge in history. This wasn't some local disruption, this was a shock to the entire global system. The impact was immediate. Global oil supply just dropped by over 10 million barrels a day. Brent crude, which is the global benchmark, shot up to $103 per barrel. The government's own energy forecasters were projecting it would peak at $115. And the price for actual physical barrels of oil that got close to $150. And all this volatility created a pattern, a very suspicious one. On March 23rd, someone bet $580 million that oil would fall right before an announcement that did just that. Then, on April 7th, you have that $950 million bet we talked about. And again on April 17th, another $750 million. That's three incidents over $2 billion, each one timed with what just looks like impossible foresight. Now, while all of this high stakes drama was playing out in the oil markets, gold was quietly doing something even more extraordinary. You see, in 2025, gold hit more than 50 separate all time highs. It rose over 64% for the year. To put that in perspective, that's the best annual performance for gold since the 1970s, which happens to be the last time the global monetary system was under this kind of genuine structural stress. And this isn't just fringe speculation, just look at the official forecasts from the biggest financial institutions on earth. Right now, as we speak, gold is trading around $4,765 an ounce. JPMorgan is projecting $6,300. Wells Fargo is calling for $6,100. And Goldman Sachs $5,400. So you have to ask, why is this happening? Well, the first reason is a number that most of us understand intellectually, but we rarely feel it's true. US national debt is approaching $37 trillion. The interest payments alone, just the interest, will top $1 trillion this year. That is more than the entire US military budget. And here's the unavoidable mathematical reality. A debt that large will never be fully repaid through taxes or economic growth alone. The only other way out is something called currency debasement, and that's just a fancy term for making money worth less by printing more of it. When your currency is worth less, hard assets that have a finite supply like gold naturally become worth more. The second reason is who is doing the buying. It's the central banks. In 2025, they bought over 1,000 metric tons for the third year in a row. That's a completely unprecedented buying spree. Let me be really clear about what that means. The very institutions that print money are aggressively trading that money for physical gold. And then, late in 2025, a quiet but truly monumental shift happened. Global banking regulators officially recognized gold as a Tier 1 asset. For the first time in the modern financial era, gold has been put on the same level as cash and government bonds. It's now a foundational reserve asset for the entire system. So now let me show you the connection that most financial coverage is completely missing. You see, gold and oil aren't moving independently. They're moving together for a very specific reason. And that reason is the dollar. The US dollar fell 6% in 2025. When the dollar gets weaker, commodities that are priced in dollars, like gold and oil and pretty much everything else, get more expensive. But the dollar's weakness right now isn't just a normal market fluctuation. It's a symptom of policies that are designed to reduce its purchasing power over time. And history is very clear on this. Every single time in the last century that US debt became mathematically unmanageable, gold rose significantly. It happened in the 1930s, it happened in the 1970s, it happened after 2008. The situation right now is the most concentrated version of those exact historical conditions that we have seen in decades. But let me give you the other side of the story, the part that most bullish financial content tends to conveniently leave out, because just giving you the bull case here would be a real disservice. Gold does not move in a straight line. During that huge bull run in the 1970s, gold actually dropped 47% over 2 years, right in the middle of the rally. People who panicked during that drop sold at a huge loss. It was only the ones who held on through that volatility who saw the full gains. And as for those $6,000 gold forecasts from JPMorgan, well, research shows that 80% of long-term commodity price forecasts from major banks just fail to happen. These are educated guesses made by very smart people, for sure, but they are not guarantees. Really, the most honest way to think about gold is this: it's insurance, not an all in investment. It doesn't pay dividends or generate income. It simply holds its value when paper money doesn't. And that's why most financial planners would suggest a 10 to 15% allocation, not 50 or 100%. So we have this geopolitical crisis brewing in the oil markets and at the same time, a truly historic rally in gold. Here's how they tie together. And the one big question that's left: the oil story is about a geopolitical shock, a conflict that closed the single most important shipping lane for global energy. And it really seems like someone knew when that crisis would ease up before the public did. The gold story is a bull market driven by structural conditions, massive debt, currency debasement, and central bank buying that have preceded every major gold rally in history. Look, the question isn't whether these things are happening, they are. The real question is what you do with that information. And that brings us right back to the beginning, those $950 million oil bets. Was it insider trading or just an incredible coincidence? Honestly, this is the most interesting open question in commodity markets right now, and I genuinely want to know what you think. Let us know in the comments.